Phone Martello, Chandra, we're starting in 2 minutes. Stand by. Hi, everybody. Scott, everyone doing okay? I want to welcome our viewers from investing.com. Hope everyone's having a decent week. Enjoy the super moon in the sky tonight. Super moon plus NFP tomorrow equals inflection points. I thought I'd take the opportunity to, hello, Kevin, to do a little coaching. And those of you that trade equities and ETFs still experience this, but the 24/6 nature of the cash spot FX market, these things don't happen as much there because the markets don't close. So thought I'd talk about what's happening here in yields since everyone's really more focused on equities. I've had a bias that yields were going to start heading up, and I want to talk about this formation that we have here. So let me just move this out of the way. Good morning, Monica. So you can see the market gap down here and move sideways, kind of a saucer look in yields. And if you go back further, this was the panic crash low down here. We've been grinding up. The point being, there's formation called an island bottom, island top, and that's where a market will gap down and move sideways. And then yesterday or the day before, we gapped up, leaving this island. You see this island, everyone? Ever watch the TV series Lost, which also was about an island? Well, all of these people, if they were bearish, they're left on Lost. Okay. And as long as this gap holds, island bottoms, island tops are rare but high probability reversal formations. So there's a look there. In fact, I think it was about a month ago here at on a Thursday when we're live streamed on investing.com, that I talked about a way to participate in higher yields could have been the ETF TBT, which is the opposite, the bearish TLT. So you could see you have the same formation here in TLT, gap down. Anyone who was shorting TBT here is now on the island loss. The island actually started here. So, this could be a breakaway gap as long as we don't fill these gaps right here. Higher levels, I actually have a target of up around, I think we could get back to the rebound high here would be about 20. Okay, so we'll see what happens. And, it's a tough position to hold when you know all the financial news is going to be about extreme, unprecedented weakness. Whereas in 2008, it took 3 years to get to the unemployment levels we're probably going to see tomorrow. Hard to be bearish bonds in an environment like that. So part of the reason is last year, a lot of money was moving out of equities and into bonds. I think it's the most crowded trade out there. I think I have agreement by some of the people that are highly respected, like Gunlich. He's actually, I think, more bearish to corporates. I'm more bearish to sovereigns because of the fiscal position the U.S. is in right now. Also, there was an article that part of the administration's plan for possibly punishing, and we know there are a lot of bellicose statements that come out of Washington nowadays, but it was actually a threat by the administration to default on the bonds to China, not repay them. And, when you start hearing talk like that, it wouldn't take China having to unload. They have a ton of them, I believe. They stopped being a buyer a few years ago. They weren't accumulating them anymore. They were accumulating gold, but they still have vast treasury holdings. And they wouldn't have to liquidate their whole bond portfolio to create some type of panic here. All you would have to get is a piece of news saying Chinese, they could sell $1 billion, which is nothing. But the fact that they do that could cause a panic in a crowded trade like this. So just wanted to talk about this. I know a lot of you guys are much more focused on what's happening in equities. And last Thursday, when we were here, we were at the 61.8 level up here. So we had retraced a little more than 61.8 here. I think my comment was, if your stocks were not performing and rebounding with the market, that wasn't such a good sign. In fact, I saw a chart that growth versus value is back to all-time highs, which is, people betting on one heck of a rebound. So anyway, we got this pullback, and I said, anything that's not performing for you after this will get cheaper. Still think this level could be revisited here. I guess the question is now back through 2,900. And I saw my one of my colleagues' comments. Stelios is very good macro, and I noticed your comment about 3,100. And there's a lot of confluence there, Stel. This is where the wedge started. I guess you have to go back. Yeah. Okay. The top of the wedge, 3,100 right here. So if we get 100% retrace of this wedge, it would be 3,100. And the other part of it is, a lot of people are paying attention to this megaphone formation, excuse me. Here it is. It's this line. And then we had the big throw over blow up. But then once we got back inside of this formation, you see what happened. So that too, 3097 still. So, when I was down here, actually saw the lows, and we talked about the lows breaking out over 2,400. Well, I was talking about 3,100. Everyone thought I needed to be taken to the nearest mental institution. And last time I was there, I was using mental stops, and my first stop was a mental institution. But you have some confluence up there still at 3,100. So
Yep.
see what happens if we get back up to the megaphone line. So you could see, one of the advantages of being part of Forex Analytics is, I pay attention to what our team is thinking and their biases. I'm a big believer in intelligence gathering, and we have a great team here. at Forex Analytics, and you'd probably have to go to 5 different sites to get the kind of research and technical breakdowns of all these different instruments. I remember Blake was at a different company, and I was at FX Street, and I was at FX Street, and Grega was winning awards, and he had his own business, and Stelios I just met. Steve, I actually told me I interviewed him on FX Street, and I hope I didn't hurt his feelings. I told him I didn't remember because I've done almost 1,000 of them.
Haven't slept since that day, Coach.
I'm glad that you've recovered. Like I told Steve, I would pay for his therapy. So anyway, I mean, an excellent team. Maybe you've seen Joe on Bloomberg, and Paulie does a European crossover. Blake holds Paulie in very high esteem because he noticed here's another real guy who trades for a living, and you get Paulie's European crossover before the U.S. Open. Spend some time in our chat room, and you'll see about the efficacy of Amanda Sweeney's trading. Andre, one of the more difficult forms of technical trading is harmonics, and he's an artist with his technical work. So, you may want to consider joining. Okay, try it out for a month, and we have trials too. But my belief is I like this because I don't care if it's us or it's a money manager or it's a new system you're trying. You really can't make an assessment of anything in 30 days. I kind of have a rule: you don't make any judgments or assessments for 90 days. And that could go with your romantic life too. So I recommend that you try us. We even have a light version where you could just get a feel for it. You get plenty. You get all the push notifications here. The only thing you don't get is you don't get the members chat room, and I think that's one of the most valuable. The community that hangs out together during face, after face is one of the best parts of
Dale,
what we do. Yeah.
during the trial for Light, they get 10 days of full access, so they get 10 days of the premium.
Okay.
But having said that, the differences between Light and the premium are a lot more. They don't get harmonics, they don't get Elliott waves, they don't get patterns in play, they don't get the chat room. So those are the differences.
Anyway, my joke for Light is Forex Analytics said, "Let there be light," and here it is. So, invest in yourself. If you think that, just someone trying to get more money out of me, let me tell you something. I'm going to end it on this. You're going to pay to learn, or you're going to pay the market. And how do I know that? Because I have. Okay, Blake. So here we are. Euro still, trying to dig its heels in, but pretty ugly looking week so far. I sure have a hard time wanting to short it down here. I have a potential third drive down here at about 107, but
yeah,
possible we dig our heels in before we take out that low.
I'm with you. I don't. It was, to me, I was short early in the week, and I did not capture this whole down move. Far from it. Excuse me. But to be on the short side earlier this week when you're closer to 110, on the failed breakout. Here, let me just go ahead and grab the chart really quick. I was short going into the weekend because of this false breakout. It was very clean and clear.
Yeah.
So we gapped down and we moved lower, and that was the right trade at the time. I personally didn't think we'd be down here this early. I thought we would be down here by the end of the week. but following the jobs report for tomorrow. So that's, for me, it's like, yeah, now that it's down here, we risk, in my opinion, it's a coin toss going into tomorrow. Why do I say it's a coin toss? It's a coin toss because we're dealing with the jobs report, and honestly, we all know that it's going to be a weak number. We all know that, right? I mean, the question is how weak. And I mean, we've got unemployment claims today, which is expected, what, 3 million new claims. Let me see here. This is via Bloomberg. So yeah, so we're expected 3 million new claims as of today, and then continuing claims at almost 20 million. And then tomorrow, for the jobs report tomorrow, we're expecting a loss of 21 million jobs. Is that right?
Yeah.
Am I reading that correctly, Stelios?
Yeah.
Yeah. That's
yes, you
million.
are. Yeah.
Yeah.
It's a monthly. Million. It's a monthly figure, right?
It's a monthly number. Yeah. So we're expecting loss of 21 million, and I mean, we all know it's going to be a bad number. So it's like, well, how's the market going to react? Is the dollar really a safe haven? If it's worse than expected, let's say we come in with negative 25 million job loss. Does the dollar still strengthen as a risk aversion tool, or does it actually weaken? My opinion is it'll still strengthen, even if we get an initial bout of weakness. But this is the way I see it now, because I have to. I'll go back and explain just what I was saying. I thought we would be here by tomorrow, and then after the number, we would be closer to 108. Now we're here. So my assumption is tomorrow we're going back up here, or we're going to break down. And even if we pull back to like 109, I am a seller here. So like, and I'm going to give you guys will hear my my analysis tomorrow. It'll be the same, I guess, if we're here where we're currently at. That if the number's weak and the euro dollar bounces because of a weak number, I am going to sell into strength, meaning I'm going to buy the dollar on weakness. So if we do, oh wow, the euro's coming under a little bit of pressure right now. We're actually at the lows nearing the lows of the day. But like I said, if the euro weakens following the dollar weakens following the number, I'll still sell the euro into strength. That's the way I'm looking to play it. What I'm scared of happening tomorrow is that the number's bad, the dollar just rips, and we break through, start trading down towards 107, and then then I have to chase it or not do anything tomorrow, which will probably be the case. Is I'm just not going to end up doing anything, trying to chase it lower. But yeah, so Dale, to answer your question here, I don't know what to do with the euro. I don't want to be a buyer, but then again, I don't want to be a seller ahead of not only the weekly unemployment claims today, but also the numbers tomorrow as well. So this one's kind of off limits to me at the moment. One of the and Dale, I need to give you a little compliments of focusing on the bond market a little bit, where everybody's focusing on equities. I think keeping an eye on the bond market is going to be very important, especially going into the next couple of days. And this is where your what would you say, Dale? 400 or 500 years of experience pays off. I'm joking. I'm joking. He's got it on mute. I like to harass him.
He's not talking to you anymore.
Yeah, he's probably yeah, like whatever. But anyway, no, really focusing on the bond market tomorrow might give us some better clues of what to do with the S&P. One of the other things that I'm looking at this morning is the U.S. dollar Canadian. Now, the reason why I'm focusing on the U.S. dollar Canadian is a couple different reasons. Yesterday we broke this. Let me just take this down here. I'm going to pull this out a little bit. All right, so this is we had this wedge and we broke higher yesterday. Bull flag looked like it was going. And then now we have this little false break right here. Now, one of the reasons why the dollar Canadian is weak, if you guys are not following it, is crude oil is strong. So crude's still bouncing back, and crude is challenging these previous highs, or actually the highs of the week. So that's allowed for some Norwegian krona strength, some Canadian dollar strength, and that's pulled us back here. I actually think the US dollar Canadian is still going higher. So what I'm looking at right now is the fact that we're sitting on the 618 retracement, basically the trend line. And I think that the dollar Canadian needs to hold around these levels in order to bounce. But I think you got to be very careful being short the US dollar Canadian, especially keeping in mind that Canadian jobs report is also tomorrow. So it's not only a US jobs report, it's Canadian jobs report as well. And I think the dollar Canadian down here, sub 141 might provide us some opportunities for a bounce. So just keep your eye on the dollar Canadian. One of the trades that one of the markets that I was really surprised, and actually I'm going to have to look at all of these for you guys, is the Aussie yen. I had moved my stop because of this. You can take away what happened overnight, and let's kind of see what we were dealing with yesterday. We had a breakdown in the Aussie yen, and this is a bear flag, pennant, whatever. So I've been riding this Aussie yen short, and it was doing great. And then I moved my stops up to 68.50, which was basically, I didn't want it to get past these highs. I thought we could come back and retest the 68.20, 68.30 level. I just didn't want it to get back up above here. And so I moved my stops, and as you can see, the Aussie yen just ripped. And I was actually surprised this morning when I got up, and I was like, man, I got stopped out for a profit. But I'm a little irritated because we had, it was obviously, everything was looking great going into yesterday afternoon. And the problem is that all of these yen pairs look exactly the same. You have the dollar yen, which might have given us a false breakdown. Now, I'm still monitoring this trend line. As long as we stay below this 107 level, it's still bearish. Because keep in mind, we've done this before. What you're seeing here is not new. Go back to here. Okay. We had this wedge breakdown, false breakdown, hit the 38% retracement. If you don't know, this is a 38% retracement, right? Hit the 38% retracement. Let me delete that. Reversed. Hit new trend lows yesterday. And like I said, we're getting a false breakdown. I wouldn't be surprised if we do one of these again, just like we just did. Back up to 107, and then then that means we're forming some sort of wedge. Probably looks like that, versus being just a bearish wedge, of a straight up bearish wedge. Now maybe it's a descending wedge, but yeah, it's not just the Aussie yen, it's the dollar yen. Euro yen did the same thing. Well, is trying to do the same thing. We had this I was expecting a move down to 113.90. We made it as low as 114.40, but I was really expecting a move to the 127% extension of this this last range you can see here. So I was expecting us to get down there. We didn't quite make it, but the euro yen might be at risk of a false breakdown, right? The guppy, very similar situation, right? The guppy's actually testing some pretty key resistance right now. Yeah, the false breakdown in the Aussie yen. New Zealand yen, false breakdown. I was looking at this thinking, oh, here we go. We're going to break out of this wedge. We're breaking lower. It's doing the exact same thing. The Aussie yen is done. So all in all, you just have to be careful with these yen pairs. These yen pairs look like they're breaking, and then all of a sudden, here we go. They're just quickly reversing the other direction. That's obviously with risk. We have the S&P that is rallied back towards these highs. We are still, and this may change this morning. We are still making lower highs as of right now. Okay, so keep that in mind. That's that in my opinion is a pretty significant development if we can hold these highs. What I don't want to see right now, in order for this head and shoulder to really pan out, I don't want to see us break towards 2920, because if that happens, then chances are we're going to retest these recent highs in the S&P. So still monitoring these lower highs, but when you're up where we're at right now, you have to start thinking, okay, well, how about if we do break out? This one of the overarching themes of the last few weeks have been, and you guys have heard me talk about it during the week ahead videos. You've heard me talk about it here, is asset managers are chasing the market. They are underinvested. They are consistently chasing the market higher because, not only are they underperforming the S&P, but now they're underinvested. So, as an asset manager or an institution, you can't stay that way, because if you stay that way, then, you're going to get redemptions up the yin yang. So you have to be, chasing yield higher. As much as you may think, oh man, the stock market doesn't deserve to be up at these levels because the economy is so weak and blah, 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 blah. Well, this is where the old adage comes in. The stock market is not the economy. And, the market right now is chasing prices higher. I'm not saying it's right. I'm not saying it's wrong. I'm just saying it is what it is. So you got a lot of these institutions that are just, picking up, they're buying on dips systematically and trying to be involved in the markets. Whether they get caught wrong-footed or not, everybody is a lot like Warren Buffett. Even though Warren Buffett said this last weekend he doesn't find anything attractive here, he also mentioned that he missed the bottom. So where I'm assuming he's not the only one. There's a lot of institutions that are trying to play catch up right now. So anyway, all stuff worth noting at this moment. And the S&P, like I said, is up at pretty key support. I don't want to be bearish, like outright bearish the equity markets, unless we're below 2,800. I do think that seasonally we are in a very tough time for bulls to eke out too much further gains. But whether we peak this week or whether it's next week or maybe even 2 weeks from now, we are in May. So I think we need to be looking at, sell in May, go away, but it could be at the end of May. It could, we still have to be open to the idea that the market, the upside in the market is not necessarily over currently. I need to be open to the idea that we can still test the 3,000 level, which is the 200-day moving average. I still think that this is a doable target up here. I hope it doesn't get up there right now, especially that I just picked up some Euro Aussie, but that's another story. Anyway, I just wanted to talk about those few things before the weekly unemployment claims come, and I'm going to turn it over to my colleagues, Steve and Stelios. Good morning, gentlemen. How are you?
Good morning, sir. Good morning, everybody.
Good morning. How are you doing?
I'm very well. Very well.
Good. Hey, good morning, Steve. So yeah, 21 million jobs. It's amazing. Yeah. It's a lot of jobs. How's Greece's economy right now through all this?
Good question.
Great. We're about to start making loans to other countries.
Oh, really?
No, the question is what's the GDP, the next GDP print's going to be? And Greece is heavily dependent on tourism, and tourism is dead. So I'm not too optimistic at the moment.
So you're saying no one's in Santorini right now, but the local Santorinians?
This is the opportunity for us Greeks to go to Mykonos and Santorini at reasonable prices.
There you go. Now we're talking. Gosh, I wish I could be back in Santorini.
From a personal perspective, reasonable price for Mykonos is something like minus 200 euros per day. Because
I'm not a fan at all.
I went to Mykonos for my for when
Skiathos, I'd rather prefer. We have a friend here, Didier. Skiathos, I would prefer Skiathos 100 times over it. Yeah.
George, maybe we could work out a deal. George Vlatakis has a hotel in Santorini.
There you go.
Oh, nice. Okay.
Hey,
there we go.
We got a Forex Analytics discount promo.
Please.
Can we take a trial at your hotel?
By the way, I was supposed to go this summer, and it looks like next year is going to be my year to go back to Greece. So anyway, hey guys, I'm going to pass it over to you. I got to get to the markets. Everybody have a great day.
You do, Blake.
Thursday to you.
Thank you, Blake.
You do, mate.
Good luck.
So we have the numbers in about 50 seconds. So let's wait for that first. And then we talk about the rest. So jobless claims, we had a couple of weeks where we had, what was it, 6 million and 8 million, or what was it? Now it's tapering down slowly, but still.
Yeah, we had 2 weeks that it was about 6.6 million.
So we're still.
It's tapering down still because we're running out of population to be employed, unfortunately, in this space.
That's a good point. It's sad, actually, but it's a good point.
I mean, we're still talking about an estimation of another 3 million people.
Yeah. So after this number, we're going to be past the 30 million mark within about 6 weeks.
We're going to be roughly, if it's 3 million, we're going to be roughly at the 30 million mark, yes, which is unbelievable.
Let's see. Any second now. 3.169.
Almost 3.2 million, yeah.
Yep, continuing claims is worse than expected.
Continued claims, 22.65 million.
Yeah.
That's pain.
Okay, well, let's see what payrolls brings tomorrow. But I think given those numbers, we might see slightly worse than expected. Although I'm sure the projected number is going to be changed from today until tomorrow for payrolls. But anyway, this is, I think the market's accustomed to the fact now that we're going to be getting bad jobless claims numbers for a while, and hopefully slowly it peters down. Now, Coach talked about equities this morning, and what I wrote. Basically, if you're a Forex Analytics member, you'll know I do the macro analysis, and I have a bias for each instrument, just like everybody else does, actually. And I had been neutral equities and switched to bearish when the S&P was around 3,100, DAX was around 12,000. That was in early March when the whole coronavirus thing was really in swing, and the markets were basically ignoring it. So we had this leg down when we got to, I didn't catch the bottom obviously, but around 2,400 or 8,700, 8,800 in DAX, I switched back to neutral. And now I went bearish again a few days ago, around 2,900 in the S&P, and what was it, 11,000 DAX. Basically, my thinking is that I think we're going to get another blow off top. I've said this before in this webinar. I said it in the chat room. I think because it makes sense to be short, and there have been a lot of people who have been short, sentiment positioning has been short. It's been reducing recently, but I still think that due to positioning, we might get another little blow off top, maybe towards your 3,100 target level, Coach, could be. We might not get there, but I think we will. So my bias is to be short equities now, and I think we'll have one leg lower. Where do I think we go? S&P 2,400, maybe even towards 2,000. I don't know. It depends on a lot of things, but for sure, the Fed and the other central banks, they're putting everything they have to it into this. So eventually, they're going to succeed, and in nominal terms, we're going to see much higher levels in equities. But first, I think that there will be another run as the opening up of economies doesn't show, or I don't think it will show, the recovery that we expect, that the markets expect. I don't think we'll see businesses going back to normality anytime soon. So This is my view on equities. And unfortunately, or fortunately, however you want to see it, equities are driving pretty much everything right now. I think FX pairs are being driven by equities as well. So you see commodity currencies, even sterling, when equities rally, they go one way. When they fall, when equities fall, they go the other way. So it's I think equities are calling the shots at the moment. But
everything has become a Roro trade, Stelio, eh?
Yes,
risk on,
yes.
risk off.
Risk on, risk off, exactly. So that's why I'm very cautious with currencies. I have a couple of conviction trades, especially Norway. I've been talking about this for a while. For people who didn't see this, Norges Bank met today and they surprisingly cut rates 25 basis points. So they went from 0.25 to 0%. Don't ask me why. I have no idea what they're thinking or how they think that these 25 basis points are actually going to help in any way or change conditions materially to warrant this. But anyway, they unanimously voted for a cut. They're now at 0%. And what happened? The Norwegian kroner, it dropped 0.5% after the announcement, and now it's back at days highs or lows in terms of Euro Norway and USD Norway, which is what I'm looking at. So, I think everything is still driven by risk, and you need to be careful with FX. Even yen has been correlated with risk for a while, but now you have commodity currencies who are doing the same, and sterling. So I think we have to be a little bit careful, and my sizing is definitely lower than it used to be. So what else do we have? Oil is driving higher. We had the inventories number yesterday, which was better than expected, and I think oil is also interesting because remember last month's shenanigans with the May future where we went minus $38, whatever. I think a lot of people might have expected this to happen with this expiry, and it's not yet. So I think people may have been caught short and are recovering. I don't know. I'm just
crude is holding up quite nicely. I mean, the continuous is still testing this triple confluence of resistance is near $20, Stelio.
Yes, agreed. So oil is difficult. Do I think we could see it going lower into expiry? Yeah, it's possible. It's possible, but again, it depends on positioning. It depends on a lot of things. So what else do we have? We had actually very interesting number. I was looking at it again and again. I can't actually explain it, but we had Australian trade balance today, the best reading on record. This is amazing, right? So they had, and I actually.
Stelio, I have an assumption about that.
Go for it.
What was mainly hit by the lockdown? I mean, what responds fastest to such conditions? Consumption of, everyday consumption. And I'm not talking now about, food, but everything else, other than the absolutely necessary to survive, they immediately get shut down. I mean, people stop buying cars, they stop buying televisions, they stop buying, anything that's non-essential, immediately ceases to trade.
Absolutely.
So think about it. Australia is a country that exports a lot of raw materials.
Yes.
Demand for those usually does not adapt overnight. But demand for all the rest of the products, which are mainly imported and not exported from Australia, got shut down immediately.
That's
so in essence,
that's a very good point.
So in essence, I think that the trade balance was, at record highs because all the stuff that the average consumer buys, which most of them are imported, stopped being bought. But, whatever deals Australia has to export, like iron ore and, tons of shit they produce, it was still ongoing, at least, up to a point. So I think that's a difference.
That's a good point, actually. Well done. I didn't think of that. Yeah,
it's okay. It's a collective effort.
Yeah, so we had this number, and Australia, the Aussie has been outperforming today, so that's interesting. We also had Bank of England today. They're not changing rates, are they? So 9-0 to stay unchanged, and there were two dissenters in terms of the QE who wanted an extra 100 billion in QE.
Gatakia.
Yeah.
100 billion, like pocket change. Come on.
So, but that's still a minority. So
no need to bother for anything else than $1 trillion anymore, right?
Yeah. I don't get out of bed for less than $1 trillion.
Yeah.
So the pound didn't really react to that. What else do we have? We had some industrial production numbers. Germany minus 9.2%. This used to be positive, obviously.
Yeah.
And France, what was it? France minus 16.2%. So it's, these numbers are expected. But even though they're expected, every time they come in and you see them, you're like, oh my God, this is a big deal what we're seeing.
Yeah.
So that's in terms of numbers. And then we have the usual Donald Trump stuff, where basically there are now threats of terminating phase one deal between US and China. So I guess this is worth another, 300 points on the S&P and to the upside.
Yeah, obviously to the upside, and even better, when this problem gets resolved, it's going to be worth 3 times that.
Yeah.
Right.
Yeah.
So
exactly.
Create a problem, find the reason that's bullish, for example, because the Fed is going to stimulate more, and once the problem gets resolved, not worry about anymore not getting the extra stimulus. Just focus on the positive aspect that the problem got resolved and rally even more.
Yeah.
That's the markets we have today.
We've said this many times that at some point this whole virus thing is going to subside, and we will get back to some kind of normality, and then we'll have to worry about the old things like the US-China deal, Brexit, and all that. But hey, we don't care about these at the moment. So that's how it is. And apart from that, I think we're all waiting for the weekend and payrolls tomorrow, because every week feels like it's a month recently.
Yeah, lately it does, doesn't it?
Yeah, it does. But, opportunities out there. But as I said before, I am paring down my sizing quite a bit because this thing can make you a lot of money, but it can destroy you as well. So that's just me. So that's it for me, my friend.
Perfect, Stel. Okay, time to jump on the charts. Although admittedly, nothing much has happened since yesterday. It has been, a rather quiet last 24 hours for the vast majority of the tickers we monitor. There is a question from Tumiso if he can ask something. Yeah, absolutely. That's why we're here. You can ask whatever you want. And if it is something we can address, we will gladly address it. So coach, any personal requests where you want us to begin from?
No, buddy, just go with the crowd and what they want to see.
Okay.
Thank you.
Okay, so let's see what they want to see. Not many questions. Most of you are here daily, and as I said, okay, so we have a question about the metals. So let's start from there and crude, and then we'll go to FX. So metals. It couldn't be more obvious in my eyes. I mean, it's textbook. We've said it, many days ago. It looked like a triangle, and I think that we now have, a lot of price action to be even more confident about that possible interpretation. Somebody could also see here in gold a potential head and shoulders formation. It's not out of the question, but I'm a lot more, convinced that it's probably a triangle. So, interpretation of such a formation would be that we will have at least one more move to the upside. And if you have a look at silver, it's more or less confirming the same type of formation. So gold, silver, they seem to be coiling here. As we know, consolidation, which in essence is the contraction of volatility, at some point gets resolved with an expansion of volatility, meaning you should see probably an acceleration of the average true range for at least a small period of time, in which case we will probably see a breakout. And as I said, I still favor a breakout to the upside for both those metals. $16 is the first technical barrier for silver to the upside. It's the confluence of the 61.8% fib of the last move lower and a horizontal support resistance area. in the case of gold,
nice looks.
In the case of gold, the first upside resistance is the 127% extension of this pullback, which comes at 1771, 1772. And after that, we have the 88.6% fib from the all-time high that we got in September of 2011 to the multi-year low, which we got at the end of 2015, which comes at 1821. So these are the two upside targets in the case of gold. And, until proven otherwise, I would assume that it's going to be a dangerous proposition to want to be short, because gold keeps failing again and again to break lower. And, until proven otherwise, the path of least resistance is higher. Needless to say that fundamentally, this is hugely supported by the fact that we're seeing all the major central banks printing trillions and trillions and trillions of fiat money, which we know that in the long term leads to further devaluation of fiat currencies against anything that has intrinsic value, as it has been happening for more than 100 years. I mean, the dollar has lost during the past 100 years something like 97% of its purchasing power, and it's not the exception. So keep in mind that the fact that, not the vast majority, all of the fiat currencies, some more, some less, are being devalued in general against commodities and anything that has intrinsic value is a fact. Now imagine with what's happening at the moment, the chance that this trend is going to accelerate actually is quite high. Okay. Now, two more metals before we switch. Palladium, still under pressure, no question about it. It remains within this descending channel, so keep looking lower. I'm short. I've taken most of my profits. I still have a small position here. My last attempt here was being short above 2,200, so it's a fine trade so far. But I do think that if we see risk rolling over and diving in even deeper, it has a lot more pain ahead. I believe we can even see a lower low from the $1,500. Copper is still recovering quite nicely, but I still believe that this rebound has purely corrective characteristics. So as I've said before, as long as we remain below 248, I think that there is a very decent chance that this rebound is going to fail and we're going to see lower prices, which is more or less, we know that there is a high correlation with what's happening in the Aussie and the Kiwi. So it's the same situation here. I mean, both of them are showing now signs of weakness. They're showing that the rebound has probably run out of steam, and they just need a gentle push from risk assets, and I think we're going to see them move quite lower. Now, is it going to be to produce a lower low? That's a big unanswered question. It's the same type of unanswered question we have in the S&P. I mean, I do think that current prices are ridiculously high. I do think that we're going to see them pulling back from here, irrespective of how much help they're getting from central banks. The reason that they're getting so much help is why we're even at these levels anyhow. So it's not that, all this monetary stimulus has no effect. Actually, it has a huge effect, because if we didn't have that, the market would have literally blown up. I mean, we know as a fact, Gundlach also spoke about it like a week ago in an interview in CNBC, that the bond market had gone no bid. So you understand the repercussions of that. So yeah, they saved the market once again. That doesn't mean that the market will have, under current circumstances, the strength to go to all-time highs. And in any case, the market is at all-time highs, having to do with the vast majority of valuation metrics, simply because we might not be in all-time highs having to do with price, but anything else, earning expectations, etc., GDP, are contracting. So, any type of ratio you're looking at, price has declined somewhat, but the denominator has declined even further. So, any type of valuation metric is probably at all-time highs as we speak. So keep in mind that it might not look that much on the chart, but we're talking about extremely expensive stock prices at the moment. So I do think we're going to see lower prices from here. Now, is it going to be enough to see new lows? Depends. Depends on many factors. One thing is for sure, the risk reward is at current levels heavily skewed to the downside, and that's a fact. Doesn't mean it's going to work, but it is a fact. So if you have a look at the rest of the indices like the DAX, you see more or less the same picture. Broke out of this rectangle, reversed lower, consolidating. I do think that we're going to see lower prices from there as well. Here's the FTSE 100, same deal, overthrown, an overthrow from the ascending wedge, pennant in this case, broke down, seems to be recovering, but I do think we're going to see lower prices. More or less, whichever index you see is showing you the same things. Now, crude oil. There it is. So, crude oil suffered somewhat yesterday, already recovered all the losses today, so far at least, it's early in the day. Keep in mind, as I was saying yesterday and the day before yesterday, this is a triple confluence of resistances. This is a triple confluence of resistances. Previous lows, you can see it here. Descending channel trend line resistance there, 50% fib. If you want to add a fourth factor here, it's a psychologically important level. It's a round number, $20. This is the continuous, by the way. I'm using the continuous because it doesn't suffer of the increased volatility we see in the futures when they come close to expiration. So it gives you the ability to have a much more coherent market structure, and it paints a much more objective picture in the longer term view of this market. So that's why I'm using the continuous, and I think when it has to do with plotting technical analysis, I think it's the best choice here. At least that's my point of view. So natural gas, we spoke about that a few days ago. $2 was important. We literally shit the bed yesterday and we dumped below it after getting rejected from the 200 daily moving average. Having said that, what remains a fact here is that we're seeing a very big divergence between what natural gas has been doing and what crude oil had been doing, because crude oil was even at minus 37 at some point, I mean the future contract, and natural gas was still producing higher lows. So I think this is another indication that the path of least resistance for energy is to the upside, because once we see the economy to start recovering, I do think that current prices are completely unsustainable, and we're going to see within the year much higher prices in the energy complex. Let me go through some of your questions. Aussie yen formed the double bottom yesterday, so it's still going to rally high. Okay, so since you're talking about short-term charts, let's go to a 4-hour chart. Double bottom. Where is it? Do you consider that a bottom and that a bottom? Because that's not a double bottom. I mean, you can talk about a divergence because we had a lower low on the 4-hour chart and we had a higher low in the RSI. Okay. Now, having said that, I still see a pennant here. We've broken below it. And I still believe that there is a very good chance that we're going to see lower prices first. So if you're asking me, I think that in the short term, the path of least resistance remains lower. And in the case of Kiwi yen, something similar. Now, not that easy. I'll have to choose another color and assume that that's the type of formation we had more or less there. Okay, admittedly, quite choppy price action. I think the Aussie yen looks better. Okay, let's see. Can you do USD PHP next? USD PHP. Okay, that's a first for me because I've never ever traded the Philippine peso. Yeah. Having said that, unimpressively, because that's a picture in all the exotics, what I see here is a strong move higher.
Yeah, it's kind of leading a lot of the emerging economies on this rebound.
But on the other hand, what I see there is a corrective move lower, likely. Yeah, I mean, compare the type
nice
of price action
triangle. Yeah,
you had. So having said that, it's not unlikely, if we don't go straight up from there, it's not unlikely to see something like that. Okay, but there is also a decent probability that you're going to see something like that. Now, those of you that are frequently here, you know that I do believe that all these exotic currencies, in the not so distant future, they are going to gain a lot against the dollar, but we're not there yet. Probably, actually.
When will we be there? Give me the day.
I obviously cannot give you a date.
Give me the time then.
What I can tell you is that, in my opinion, within the next few months, worst case scenario within 2021, if you want like a macro assumption from me.
I want the day.
We're gonna see the dollar start melting lower, and once that happens, there is gonna be a vicious cycle beginning for the US and a virtuous cycle beginning for all the emerging markets, because the vast majority of them have a big percentage of their debt denominated in dollars. So once that starts happening, they're gonna, in essence, get some type of a debt jubilee, right? Because their nominal debts are not going to be moving lower, but the cost of their actual debt is going to be moving lower along with the dollar. And once that happens, the virtuous circle is going to begin for these economies, because once their debt burden starts getting a lot lighter, they will have the ability to overperform and sign once again. So, from a macro perspective, I do believe that during this decade, we're going to have, these economies blossoming. That's what I believe is going to happen.
Yeah, I think that'll happen in the next 10 years too.
Yeah. But keep in mind, Dale, you know that better than anybody, since this is your 13th decade in the markets. In many cases, market themes last for many, many years, right? Yeah. So it's not easy to say in advance when the new theme is going to be introduced, but you can have the confidence that once it does, and it starts becoming obvious, there's going to be still a lot of time to benefit from that.
It takes a long time to turn the battleship around.
Yes, but once it does,
right,
then momentum is going to get it going for a long time, right?
Yeah. I'm buying 10-year leaps on Philippine peso right here.
Okay. What's
Anyway, just busting
what is
your
your view on movement in treasury bills? Is there an aggressive buying of bills to other paper? Are there any early warning indicators from banks on liquidity as yet? All those issues were actually resolved. Resolved, put that in quotes, because these markets went literally no bid once the economy shut down, and they've now gone no moving simply because these markets are now almost mainly driven by the Fed. So, you know, do what you wish with it. You know, I'm not even sure they qualify anymore to be called the markets, you know, because market theoretically is, you know, an accumulation of buyers, you know, and, you know, big amount of buyers, big amount of sellers, and price being determined by their common understanding of where value lies. In this case, you mainly have one buyer in the market, and the prospect is that that main buyer might even end up being the only buyer in the market. But on the other hand, a buyer that has unlimited amount of money, since it's being printed out of thin air, to keep buying this. So, you know, personally, I've almost stopped looking at the treasuries. I mean, of course, I do look at them like a couple of times per day, just to look at them to make sure that, you know, something isn't happening. But I think that unfortunately, this is another market that has now probably been, at least in the short to medium term, completely killed by the policymakers' actions.
Yeah. Someone wants you to take a look at the Thai baht. And Peter Bookfire, when we had the summit, that was one of the countries he was constructive on. So I think it's USD THB.
Tell me again.
USD THB. Tom, Harry, Billy.
USD Tom, Harry, Billy.
Thai baht, there it is.
Very beautiful pennant here, right?
Well, that's been,
enough said.
Yeah. But I mean, it's not close to making new highs, you know. So it has been one of the emerging economies whose currency hasn't suffered as much as like the Philippine peso, of course, the lira, the ruble. Thank you for the suggestion, Alberto.
Okay, so that's more or less what I see here.
Yeah, it's in a
downtrend. Mean, short-term price action, you know, can it be like a big bearish reversal? Yes, it can. But for the time being, both the price action and the RSI movement are saying that there is a very, very decent chance that the next move is higher. So, you know, I wouldn't definitely be taking the short side here. Not yet. Perhaps after another high.
You said look at the monthly and you'll see kind of a bullish pattern. You want to take a look at
okay.
Mark Newton isn't here yet, so.
Here's the weekly to begin with.
Huh. Interesting. We have two drives down there. So Albert, just like my look, I don't know, there could be some more short-term weakness or strength in USD.
I mean,
but you see the lows in 07 and 14. That's, you know, drive one and two.
From 06 to today, we're in essence oscillating in a very, very large range here, with the exception of this short-term breakdown there, this one.
Yeah, that's drive two to me. So I think there could be one more drive. I think the point is all the other exotics that you showed were about to make new highs or have made new highs.
There's no question about it.
So I mean, in comparison,
it's holding much better. Yeah.
So
the THB is holding much better. There's no question about that.
Yeah. So very nice observation.
I mean, just look at, for example, look at the USD Turkish lira.
Ruble. Oh yeah, the lira. Yeah.
Just compare.
Now, if that ever turns, then the dollar's really in trouble. That looks like drive 2.
I don't know what it looks like, but it looks like probably
to me,
the most battered.
Some people have double vision, Steve. I have triple vision because I see everything in threes. Okay.
Absolutely. Okay,
Man,
so
I'm funny.
We have a question. We have a question
handsome. And people like me.
All of that. So we have a question about the cable. We mentioned that yesterday. So 2 interpretations here for cable. 1, triangle, in which case bullish interpretation. Second one, this incline head and shoulders formation. We're attempting to break lower from that now. If that's the case, I want to see acceleration and I want to see a lower low. So I want to see a move below 122.50. If we see a move below 122.50, I think that the cable is going back to 120. As long as it's holding here, there's still nothing really bearish with it. I mean, it looks heavy, unquestionably. But I want to see, a move below 122.50, and then I'm going to be looking for 120 to be hit at the very least. So that's what I think about the cable. Oh, Dale, Mark says that he's actually here.
Oh.
Yeah. So
I don't see him under the panelists. What's he registered under?
Doesn't really matter. I'm going to find him and promote him. Don't worry about it.
Okay. Yeah, I looked for him.
I found him.
Thank you, Mark. Okay.
Promote to panelist. There he is. Unmute. Hey, Mark.
Hey, everybody. How are you?
Good. Welcome to the party.
Good, man. How are you?
Thank you very much. Yeah, I'm not sure why this one is different than the one. Okay, it says I cannot start the screen share while the other participant is sharing. Okay, yeah.
Now you can.
Okay. Yeah, it's funny. Sometimes when I logged in last week, it was a little bit different than this, but that's okay.
Well, that was so special.
It's because we had added you in advance to that webinar as a co-host with.
Yes.
Because.
Okay, Mark. So good to talk to you within a 1 week time span. Last week during the summit, you were pretty constructive the market, and then we got a pullback from the 61.8 retracement in S&Ps. Is this the beginning of correcting the bounce or the correction, or is it going to be pretty shallow in here? What are you thinking?
I think it will be pretty shallow, but I don't think we've obviously started yet. I mean, we've seen some evidence of breadth deterioration and momentum pulling back a little bit in the last couple of weeks, but we really have not seen hardly any real deterioration in technology. And so that tech is really the key linchpin to this whole market. And right now, tech is still, holding up amazingly well. So when you look at screens like on Bloomberg, when you look at how technology acts on an equal weighted basis versus the S&P, this goes back over the last couple of years, back on the left-hand part of the screen. This is 2018 when we sold off pretty sharply.
Okay, I'm seeing a spider chart right now, Mark.
Oh,
from TradingView.
Oh, okay. Let's see.
So you have the TradingView SPY up daily.
Can you see that now? Is that a different chart for you? Let's see.
No, you probably have to stop sharing and then show the next one. And maybe it's on a different screen.
Yeah, that's strange. I'm starting to use some new softwares outside of Bloomberg, and so the screen sharing, for some reason, we can just stick with this. That's fine.
Okay.
So bottom line is that I do view the that markets likely are going to start a correction next week. There's a big Bradley date coming up actually as of the 9th, and I think that'll affect markets starting on the 11th next week. And so but I'm not certain that we have to necessarily, revisit lows. I think that, technology for now has been, the strongest of any. You see the NASDAQ closing in on, the highs from April already, whereas S&P has been far weaker. And so S&P, barely able to, even get up to levels that were, we've seen quite a few reversals in the last couple of days. So,
yeah,
that's
I
going
was
to be.
thinking maybe, it was a big level, say the 264, 260 it was a fib level that it got through. I was thinking they had a chance to trade back down into that level before making another attempt to the upside.
My thinking is the highs from late March, and so that's right near 2634 in futures.
Yeah,
I mean, that's really the high of really the first move up off of these lows. So that's going to be really, really important. So I'm actually eyeing markets likely either today or tomorrow. We probably are going to fail similar to what we did the last couple of days, and then pull back to really test the lows from earlier this week. And so when we get under 2771, that's the real key. So for those that are inclined to stay invested, anything under that, you're going to start to see real weakness. A lot of the momentum indicators like MACD have now crossed a negative just on this churning. Technology is the only sector right now that's higher for the week, whereas, you look at financials and transportation, they've really started to see some real meaningful evidence of breaking down lately. So,
yeah, Mark, I saw a chart by Tavi Costa on Twitter where he's showing that growth compared to value is back at all-time highs.
Yeah.
Which is, kind of an interesting take if you pay attention to 20% unemployment, that growth is being favored again. It's almost like what got us to the party before the decline is also what took us back on this reflex move.
Yeah, when you have to consider that really it's been energy and financials make up a significant amount of this value trade. And so when financials start to turn down, and that's just really, it's damaging for value. And technology, of course, and discretionary have been largely growth themes. And so as the markets rallied, since the latter part of 16, growth has been dominant and just really is not, participated. So
I think this is the first time you came with a look at an emerging market in a long time. You like Mexico, huh?
So a lot of these have started to shape up a little bit. I think it's going to really take a decline in the U.S. dollar to see some real strength. These have really lagged, and so I'm just watching these. Many of them had tried to break out a couple weeks ago and have consolidated, but they are more interesting to me really over the next few weeks on any sort of pullback. For me, it's
I've been watching the peso. And it looks like the peso has one more low in it, the way we have it paired to the U.S. dollar max. And it looked like it could make one more high, which would be one more low in the peso. But it looks like a topping pattern to me in the peso. So could it also be about oil, Mark, and oil having bottomed? Mexico?
My thinking is that crude oil is also entering a time when it's going to start to be a little bit more negative. And so, we've had a decent bounce in crude, but we're actually getting close to a level where it should encounter a lot of resistance in the next week. And so, I'm looking at selling into crude on this little bounce.
Okay.
I think we're not going to get much up past, front month futures up in the high 20s as the level really to consider selling into this, and that the latter part of the month is going to be far more difficult. So
maybe a pullback towards 20 is something that I'm eyeballing once this rally terminates. Or are you looking for new lows in crude, like negative 85?
Lows, I mean, depending on what you're looking at, but it's not really in front month futures, I think, but it's something where those anomalies make it difficult to you have to really make sure you're all looking at the same thing. I think that crude in general, we're going to see a pretty substantial period of weakness just because demand has dropped off so materially, and so supply cuts haven't really nearly kept up with what the demand drop off is. And the we see the eco data today, coming in at 3.1 million new claims. I mean, it's just incredible the amount of economic deterioration we've seen, and I still think that's largely understated. I think that in the months to come, that's going to be far more damaging. That doesn't mean stocks can't rally through that. And one of my key points that I made last week was that sentiment remains very skittish from a retail standpoint, based on things like just economic uncertainty, earnings. You're seeing guide downs all around, and there's just no virus. There's no vaccine for the virus, so it just makes it very, very difficult to think that there's a lot of confidence for people to rely on. So we're in this window where stocks have rallied throughout all this, and people are scratching their heads as to why Apple's making new highs every day. But that's going to be a key piece of the puzzle when you look at just
so the economy and the market could diverge for quite some time. I mean, isn't that how it was once we came? Once we came out of the hole.
It's always proper to look at the market based on cycles and sentiment, and not based on the economy as to why it moves. But here's Apple. I mean, the stock has been a pillar of strength in the last month. So it's been tough. So those that are expecting a correction, and I do count myself in that camp coming into next week, you're going to need to see stocks like Apple really start to roll over. It's just going to be very difficult to make a case, given the percentage that Apple represents in many of these ETFs and indices, with it continuing to show very good strength.
Yeah, Microsoft. I don't think Microsoft has made a new high yet, has it?
So the stocks that represent the top 20% of the S&P, I mean, you look at how they've acted of late, and they've all shown very good signs of strength. So, Microsoft's doing very well. Apple's doing great. Google, Alphabet, also showing very good uptrends of late. Look at Netflix, which has become now the new infrastructure name. I mean, that's showing, an amazing amount of strength. And so you go on many different time frames, and the stock just looks very, very good, So instead of going out, we're all sitting at home watching Netflix, and the stock has one of the better longer term patterns out there, many of them.
The miners have been shining. Continuation, or do we need to digest some of these gains?
I did a thing yesterday on CNBC on the miners, and I was asked, and I still think the cycle for gold should still be to the upside. I still think it's very difficult to say gold's going to fall. So when you look at things like GDX, I mean, you're really just getting above peaks that have been in place since 2016 on this little surge. I mean, granted, they have been very volatile, but in general, we've recouped a lot of this damage, and the longer term chart back to 2011 is still very constructive on this. So, yes, with regards to gold, I think you do need to make a little bit of progress to see. You're
an Elliotician, Mark. Is the daily gold chart in a wave 4 triangle compressing right now, moving sideways, which would imply one more move to the upside that would be terminal. Do you see it that way? Take a look at your gold daily.
So
you still have the peso chart up there.
Yeah, let me see if I can change it. I'm going to have an easier time navigating on Bloomberg. Let me see. I'm going to try to. Can I stop share and then reshare?
That's it. Right. Yeah.
So
select Bloomberg this time. There you go. Okay. So you see the last few weeks action there?
Yeah, no, certainly. So that's something where, I don't disagree that the move up from March is right now in a little consolidation. It really would only take a move up above 1714 and really spot gold to really turn this back higher. And so when you look at it on, different time frames,
looks like just consolidation before another pop. So
you certainly can't be all that bearish on gold here, and so the monthly chart I mean, that's still very, very strong. I don't see any evidence of any real weakness. You look at the last few months, and we've barely closed negative. We finished high, so I am expecting this to get resolved by a move to the upside. I do recommend GDX. I'm long GDX and Nugget. I think they'll be fine. So, but yeah, it's going to obviously take a move above this consolidation. I did have concerns about the level of participation of things like silver. I think it largely has still been a gold trade, and silver has.
Yeah, it has been.
The positioning seems to be very still strong with regards to gold. So here's this chart I was trying to show before on technology. Only that tech. This is equal weighted tech versus the S&P, and that we saw some brief deterioration in 2018, but really, coming out of this, tech has really survived this entire little downturn we saw in stocks amazingly well. This is equal weighted tech versus the market. So, I would think that once tech starts to roll over, and there's no saying it has to, but it's at 25% of the market.
So when the strength rolls over, the weakness gets weaker.
But here's XLF. I mean, the financials are in really tough shape, and this is with yields having bounced of late. And of course, the auctions, you see a massive amount of treasury supply, and that's been important. But things like, KBE, KRE, those are down to very, very important levels. And the pattern, I would argue, is still very overlapping and choppy in a lot of these, which means that these probably can go to new lows, when you look at the banks. So, I don't necessarily love this sector. I think that
banks and oils still the negative sector of the market.
Yeah, I mean, I've been long a couple of crude plays, and so we're up to levels now where we're arguably breaking this little minor downtrend, but we're into a level of pretty massive overall resistance, I would think, with crude over the next few days, where I'm not expecting that really 30 is taken out. I'm thinking this is actually a time to consider fading for a pullback to the, potentially the teens in the months ahead. So I'd look at, the energy sector has not really kept up also lately with what has happened with crude in recent days. Even you've seen some, that's not a real constructive move thus far. So, we'll wait and see.
How about last week? And not much has happened. Still neutral on the dollar here, Mark.
Yeah, it hasn't really shown much evidence of really, making a move one way or the other. It's still, for me, you saw maybe a day of trying to break down, but this pattern is still intact. You'd still be inclined to just really trade the ranges here.
Okay.
So next couple of days, you can see things still continue up, I think, and then you'll probably be repelled again. If you break this little 1 month range, then I'd have some greater, conviction.
Okay.
So the move in rates, we'll see when this starts to change. But it was really the move in January breaking down that coincided with equities following suit when we started to break down, and so
so maybe I'm wrong, and there's another pullback in yields. It's sure trying, but today doesn't look so good. Okay, so Mark, you want to show your site, and unless there was anything else you wanted to cover?
Yeah, I'm just, I've talked a lot last week, and a lot of those themes remain in place. I'm really, I think the next week we're going to start to see some evidence of markets finally obeying gravity, and the technology probably starts to stall out finally after this little run. I think that financials are going to be a big part of that, and start to, we could see a little bit of a sell-off in financials under it, and that'll be a big deal. And so,
all right. So some type of Bradley date next week, and
for those that aren't familiar with a Bradley, I mean, we've got quite a. This is the chart for this year, which shows a pretty big turn on May 9th, and then the middle part of August. And so the longer term Bradleys were pretty amazing at signaling a long-term turn in 2000 right near the peak, and also in 2018 for those that are familiar with the long-term Bradley and how to see it. So this is, something that I've showed people. I do give it some importance, and I think that it's something that really needs to be respected when you come into these turn dates that can be key.
So look for a day when the market's up and semis are lagging. How about that?
Yeah, semis have been important. So let's see if we can. Let's pull up my website real quick and show people that, and on that note. So, Newton Advisor, I've been running technical analysis for institutions and individuals over the last few years, and you can get a trial. Just simply fill out the form above. But I put out work 2 to 3 times a day, a video. I am doing a webinar today at 1 o'clock for those that are interested, and I really try to concentrate on sector rotation and proprietary long and short ideas. I started to do some work with StockTwits and created my own room there, so I put out work there as well. But it's really something where I've really left it open towards anybody that wants analysis. I'm certainly happy to accompany you, whether it be an institution, an RA, wealth manager, brokers, or individuals.
Okay, well, thank you so much, Mark. I tell you what, people aren't going to go wrong following you. So follow Mark Newton.
Thank you very much, Dale. Yeah, it's a pleasure
Mark
joining
Newton's,
you as always. And have a great
buddy.
Next couple months. I'll look forward to joining you. Maybe we'll see some more volatility in the next few weeks. It'll be a lot to talk about. But right now, it's just been all technology, and we'll see if that changes.
Okay, buddy. Stay healthy.
Take care,
you
Dale.
and your
Take
family.
Care,
okay,
else.
buddy.
Yeah, stay happy and healthy. Bye-bye.
All right, everyone. That's Mark Newton. You can follow Mark on Twitter at Mark Newton CMT, and that's going to be a wrap for us, everyone. See people going into the chat room, members chat right now. All you have to do is join, and don't just count your pips, count your blessings. You're welcome, DJ, Sinatra, Brock. We'll see everyone for NFP tomorrow. So see everyone tomorrow. You're welcome, Tom, Scott. See everyone later on. Adios.